Hello monsters, I'm back. Let's take a look at VMware today, symbol VMW, VMware. This one is mostly a fundamentally driven bearish trade. We don't have any recent signs, at least, of bearish activity. We have a chart that is mostly neutral, but ahead of earnings that are going to be coming out after this week, it's going to be next week. I have generally a bearish view on the stock, and I'm just going to lay those out. You don't have to you don't have to place this trade on today. You have time. You have the rest of the week to see how the option activity is taking place, and we may get some earnings previews from different analysts that may give us some more color. But for now, here is my bearish view. So here's the chart. First of all, as you can see, that basically crashed last year, and then it kept coming down after the year ended, and then after that it basically bounced, and now it's been just tight range consolidation right over here. There's not much taking place. It's in between $50 and $52.50 level. Very tight consolidation has been going on for 2 months now. Although one can make a case that it is slightly rising and may actually break out from this level. I mean, if I put my volume over price resistance right over here around 52.90, if it breaks out from this level, you may see this push as high as to the next layer of volume over price resistance, which is right here at 56. Yes, you can make a fundamentally bullish, technically a bullish case that it may be setting up for a breakout. But I see a completely opposite story on the fundamental side going into earnings next week, and I'm looking for a gap down when it reports next week, and I think it's going to probably settle right here at around $45 a share. First of all, here is also a quick view on the technical side. So here's the same chart, just different layout. I just made it a little bit bigger to kind of show. So you can see how it's making higher low, higher low, higher low. The volume has been decent. Some of this was sparked by the overall market, but the volume has been decent. If it does break out from here, yes, you could see this run all the way to $56 a level, as I was just mentioning, which is the volume over price resistance right here. But fundamentally speaking, I'm looking for a breakdown, and possible first target would be 49. So actually, let me just do this real quick, just to kind of make it more clear. So here is my target, right here, if it starts to break down, right here. And I'm just gonna make it like this, and then so here is my target. I'm expecting a breakdown and possibly move towards 48.30, 48.50, which is the support going back to March lows, and then on a really bad earnings I could see this going all the way down to $45 level. So what is my fundamental bearish case? Well, here is the news that I am basically going by. This is a great research report. It came from Pacific Crest on April 7th, so late last week, and I had a chance to take a look at it over the weekend. Basically, it goes about what they're seeing in company specific, and a whole bunch of companies that are discussed over here in the cloud section. So you have a whole bunch of earnings that are discussed here: Fortinet, FireEye, Barracuda Networks, and so on and so on. And it's discussing what they're seeing around their channel checks, what the billings growth rate looks like. And the one that pops on my screen is right here, VMware. This is really the only of some 15 to 20 cloud companies that are discussed here. This is the only company, VMware, which is basically, if you look at this orange line, you'll see it's going to show an earnings decline. The billings growth that's going to, the licensing growth that we're going to see when the company reports earnings is going to be basically negative, low single digit negative, first time in 3 years. This is pretty negative. This is pretty ugly. The billings growth is going to be negative first time, and here it goes on to check our channel checks indicate spotty demand for solutions as the transition to cloud continues to provide a headwind for growth. And it also goes to shade that it is many moving parts to the story, with impending Dell acquisition of EMC has served to confuse channels to the long-term story. Expectations are modest, but we see some risk to estimates for the quarter and year. Now, to give you some color on this, when the licensing growth goes negative, we saw exactly that when the company reported earnings the last time. To show you, if you go back to the chart, you'll see how this big gap down back on January 2027. The stock back then closed at, where did it close? It closed at 49, and the next day it basically opened at 46. So it was down about 8% that time when the company reported earnings. What was the case back then? Here is this time it comes from, this is January 26th, this one comes from BMO Capital, highlighting the same exact concerns. You will notice right over here, and this is what gets me cautious very much on the stock. The management expects license revenue at the midpoint to be roughly flat year over year in 2016 compared to the prior forecast of mid-single digit growth. More importantly, because this is what tells us about the future, deferred license revenue declined for the second quarter, down 12% year over year in December, followed by a 6% decline in September quarter. So basically the deferred revenues, which has to do with how the future revenues will look like, collapsed. It was down 6% year over year in the September quarter, and it doubled. It was down 12% year over year in the December quarter. And now you're seeing that it's starting to take an impact on the billings growth or on the license growth that I talked about. We believe renewable rates remain high, but the weak environment license looking are impacting software maintenance growth, and so on and so on. The analysts went out to basically cut earnings forecasts for both 2016 and 2017. Another one I'll show you, and this one is sort of my favorite because how easily it lays out the exact problem. This is from Susquehanna. It came from January 27. Ignore all this detail, go down to this is the most important point that you need to pay attention. All right, it goes on to say, but there is one glaring concern. License revenue decline in the core product are going to steepen in 2016. VMW's theory is that growth in its new products will offset the legacy declines, and as this gets eclipsed sometime in 2016, it will drive accelerated revenue growth in 2017. While we generally agree with this concept, we struggle with not getting a clear answer as to what is driving such weakening trends in its core. The risk is that this could turn into deeper secular issue that the company will be battling for quite some time. Boom. That's exactly what I was talking about. That the trend, the deceleration that we have seen, again, 6% decline in the core business in the September quarter last year, and then followed by a 12% decline in deferred revenues in December quarter with no sign of uptick. And here you have the stock that's now going to see the first year, this coming quarter is going to show the first quarter in 3 years when we're going to have license growth turning negative. So this is pretty well telecasted. I mean, I just showed you 3 different analyst reports. So what is the story over here? I'm expecting the stock is basically to basically crash over here through $50 a level, and then it may find some support around 48, but I don't think it's going to stop here. I think it's going to go down to $45 a level. Now in the option market, there's not much activity to note. If I go back to my let's go back to our activity tracker. This is Open Order Pro activity tracker that you're very familiar with. Previously, back in January and December, the company actually saw some bullish activity because the stock was probably taking too much beating, and they were betting on a rebound. Here's VMW. So you can see there was this, this is going back in February. This was bullish. There was a large July 47.5, 55 call spread that was bought. But then they returned and they bought 5,500. This was a pretty good sized trade. 5,500 of July 47.5 puts for 450 offer. This was done on March 8th. And then more recently on March 21st, we saw some more over here. Now if I go over here, you'll see here's the open interest. So let's go to July. Here's July, and you will see right here at the 47.5 strike line, there is 7,000 open interest. That's what I'm talking about. 5,500 of these July 47.5 puts were bought for 450. That's over $2 million bearish bet, and it was open in early March, and it remains in the open interest. So how would I trade this? Well, it's pretty simple. You don't have to place this trade today because, again, the earnings are coming out next week. I mean, let's look at the exact date. It's going to be out on April 19th, which is next week after market close. You could come back to it later in the week or sometime early next week, but in my opinion, the best trade is to do nothing and just buy straight. No spreads required. Just buy straight May 50 strike puts. So you go to May, the stock is trading at 51.67 right now. You go to May and you buy May 50 strike puts. The bid and ask right now is 205 and 240, and the volume is only 10 contracts. You're looking for a move down to mid 40s. Now, one thing I will mention clearly on the fundamental side, just to kind of point out that the stock is actually on paper cheap. I mean, everybody's expecting this sort of, right? So you have 3 analysts that came out recently with very bearish views, but keep in mind the company has no debt. It has 28% of its entire market cap is sitting in cash on hand, so it's got a very high level of cash. All right, and the last thing is it trades around 11 to 12 times forward earnings, but those forward earnings are coming down. Billings growth is slowing. So if I go over here and if I go to right here, you'll see there's a pretty clear trend over here. So here's the EPS growth, and it is basically came down in September and again in January, and I think you're going to see it come down again. So right here, let me just make this bigger. So you're seeing the fiscal year 2017 EPS was 510 in September, and then it was cut down to 457, and now it's 437. Maybe it will go down to below $4 EPS, which means the forward earnings multiple expands as the earnings come down, and so it's cheap. You know, you can make a case, hey, it's like IBM. It's trading at 12, 13 times earning, but look at IBM also was crashing for a long time before they started to get new growth drivers, and then now the stock is starting to run a little bit. And it has a large cash that is on its hand. So maybe that will limit some downside. But that's not what we're seeing in the short interest. One quick I want to mention, here's the short interest. Take a look at this. This is how the short float is rising. I mean, it has doubled in the last 9 months or so. So here's June, and it has doubled. Now it's a 16.9 million shares are sold short. Here is the earnings came out, the last one. This was on January 27. So keep that date in mind, January 27. Guess what the short interest was? Let's go with January 15. Let's take a look at it was the last update. Short interest is updated every 15 days. So it was 13.2 million shares. And even though the stock has steadily risen since then and now it's up a little bit, the short interest is still, the short float is still rising, and now it's at 2-year high, 16.9 million shares short. To show you exactly what that is in terms of percentage, right here, 19%, 19.5% of the entire float is sold short. So the bears don't care. They see earnings deterioration, they see license growth coming down, they see all kinds of problem over here. So bottom line is this. We have previously in early March, we had a large buyer of 5,500 contracts of July 47.5 puts that remains in the open interest. We have a fundamentally very bearish view on the stock because licensing growth is coming down sharply, and we have a chart that's not cooperating yet, but you know what, it could change in a heart when the fundamentals trump technical, so it could possibly go down big time. So I'm recommending, with going into earnings, again, use lunch money. This is an earnings play, and I'm not recommending a weekly puts over here because the implied volatility is sort of elevated. You're getting a better implied volatility, which is 44% for May 50 puts. Just go and buy straight May 50 puts. The bid and ask is 205 to 240 going into next earnings. And that's it.